Hello everyone and welcome to RJ Sanderson TV. 2025 is off to a flyer. Roy Sanderson's alongside me as always. And Roy, welcome. Can you believe it? This is our 6th year of doing RJ Sanderson TV. How do we find you on this Wednesday morning?
Oh, excellent, Dave. It's great to be back again. I look forward to another great year.
Now, Roy, before we get into the bones of the show, how's the mood in the community been? You're obviously working with clients every day. There's been some financial uncertainty that we'll get into more detail on. How's the mood in the community been at the moment?
I think confidence is down a little bit. There's certainly a fair bit of uncertainty with American tariffs. So there's business uncertainty. Individuals, I think, are doing okay and are feeling a little bit more confident, but businesses are certainly not so good.
Big show coming up. We've got plenty of tax tips. We'll check in with some of our economic indicators and, of course, Roy's Rage coming up later in the show. But let's get into some tax tips first. And Roy, the first one that you've got for us is for people still working and over 60. What's this one?
This is a sweet spot. You're over 60, still working. You can do a transition to retirement. Now, what that means is you can take out up to 10% of your super fund tax-free. So, as an example, you take out $10,000 from your super fund, you pay no tax on that. But at the same time, the next day, the next week, the next month, you can deposit that $10,000 into your super and claim it as a tax deduction. Now, if you're on the average income at 32%, that gives you a $3,200 turnaround. Your super fund does pay tax at 15% on the contribution, so the net overall benefit is $1,700. But you've just managed to shift an additional $3,200 into your personal bank account. I think the message, Dave, is that if you're over 60, still working, we call it the sweet spot. Reach out to a wealth manager or an accountant who specialises in these areas, because that is a great tax tip.
And all the more important at the moment with so much market volatility to be reaching out to a wealth manager. So just repeat that one for us, Roy. You can literally just put it back in the next week.
You can put it in the next day, yes.
There you go.
And get the tax deduction.
There's a good one. Income protection is something that always adds layers of confusion for some people. Give us a tax tip on that one, Roy.
Well, we should know that income protection is tax deductible. And when you take out income protection, you estimate your income for the next 12 months. Now, you might make an estimate and say, I want to be covered for $120,000. But when you go to make a claim, it doesn't matter what you've paid premiums on, it matters what your actual income was. So if you're in business and your income was only $90,000, they will pay you out based on $90,000. So all those additional premiums you were paying on $120,000, they are wasted, out the window, they're gone. You don't get them back. You've been claiming the premiums as a tax deduction. And I think the message here for anybody with income protection, check the detail of the policy that your income that you're covered for is very close to what your actual income is.
Question without notice, Roy, on income protection. Is that specific income protection that's over and above any income protection that's included in your super? Or can you claim it on income protection that's built into your super?
So income protection that's paid by your super fund because it's built into your super, that's not a tax deduction because you are not paying it, the super fund pays it. So that's income protection is not a tax deduction to you. And also life insurance is not a tax deduction. It's just the income protection that you pay out of your personal bank account.
It's a good one. Protections and scams is our next topic, and it's scams are all the more prevalent in the community at the moment. What's the tip that you got for us there?
Yeah, well, the ATO issued a release to all accountants to say, let people know that there's more scams out. It's getting more technical. People having their MyGov account hacked, their tax file number compromised. Now, if you're in a company, whether it's just you that's employed or you've got workers, there's now directors' personal liability if you have a cyber security breach. Now that's very important, and I think a lot of directors don't realise that. So you must be able to show to the government that you've implemented the right policies to protect your customer data from scams. Otherwise you can be personally liable. And if you're thinking, okay, what are my options? Go to our website, look under services and scroll down for cyber security, and we will give you some options and people you can reach out to try and protect your business from internet scams.
A death and inheritance tax has long been on the political agenda. People suggesting that it's necessary to redistribute wealth in a population cohort. Roy, you're actually going to make the argument today that it's not just on the agenda, it's already in.
It is already in, and this is, the governments have said they will not bring in a death tax or an inheritance tax, but in actual fact they have. This is disguised in Victoria as probate costs. Now, the middle column shows you the old value. If you jump down to the average estate value, which includes all assets, the family home, furniture, car, jewellery, investments, boat, all those things, if they sit between $1 million and $2 million, your fee was $685, it's now $2,400. It's a 250% increase. Jump to the more financial people who have maybe a few investment properties or a property that's family home that's worth quite a bit of money. Your $7 million estate, your estate is going to pay $16,800, up from $2,300. That's a 625% increase. Now, if that's not a death tax, I don't know what is.
So, Roy, question for you on that. So if if someone was in the final stages of life and had their affairs in order and was in a state of mind to have those conversations, could you pass on assets before death to avoid those costs?
It's very important that you speak to a financial planner or wealth manager who does have knowledge and specialises in estate planning. It's actually crucial because you could save tens of thousands of dollars for the people that are going to inherit your estate. So absolutely, Dave, talk to the right people to get advice, especially as you're getting older. We want to push money to superannuation because it's tax-free while we're alive. But if that superannuation payout goes to a non-dependent, it's being taxed at 17%. So some very important planning needs to go into place for an estate plan, and reach out to one of our team or anybody who's qualified in estate planning.
Some big dates coming up. The 15th of May, agent tax returns need to be lodged, so make sure you get in touch with RJ Sanderson for all those needs. And another big date coming up is Saturday the 3rd of May, Roy. It is Federal Election Day. Not to get too personal here, but a day that I get very excited, sit on the couch and watch the numbers come through. It's better than the footy Saturday nights, I must say. But
yeah, you're a bit like me, Dave. 6-pack of Coronas, sitting down watching the election with a few mates.
It'll be a different experience once Anthony Green retires. I think he hangs up the boots after this election, so we'll have to wait and see what happens in that space. But Roy, you thought it'd be a good idea to go through what each of the major parties plus the Greens are going to bring to this election from a policy perspective regarding tax. Kick us off with Labor and what they've promised the electorate heading into this federal election.
So I thought I would just focus on the tax components, not housing and immigration and other policy points, just the tax components. So Labor, you get an automatic tax deduction of $1,000. By the way, that was recommended by the Henry Review back in 2010. That recommendation was 15 years ago, and now that's being put up as an election promise. Student debt discounts will be 20% of whatever the balance is. We will have tax cuts over the next 3 years. I put the new rates on the right-hand side. Each of us get between $5 a week and $10 a week in year 2. And the instant asset write-off, which is currently $1,000, goes to $20,000. Gets extended to $20,000 for an additional year. So they're all tick, tick, tick. I don't think there's anything bad about those.
Liberal Party is the next one.
So they're introducing a one-off, 1 year only, $1,200 low middle income tax offset. We had this in place some years back and they dropped it. That affects anybody who earns up to $144,000. The first home buyers can claim interest on their tax return for loans up to $650,000. That's a huge variation, huge change, something that's not being seen around the world. The fuel excise discount by 50% to 25 cents will save people about $700 per year. Instant asset write-off, rather than just extended to $20,000 for 1 year, will be permanently placed at $30,000 for small business. up to $20,000 business-related meal expenses for small business, which means turnover under 10 mil. I like that one. I think that will incentivise people to spend money, claim as a tax deduction. It's not booze, it's just meals, and it will help the hospitality industry. And you can access up to $50,000 from your super fund for a house deposit. Now, I put that in under tax policies because we talk to our clients about putting extra money into super and getting a tax deduction. So if you're a younger person and don't have $50,000 in super, you could throw that $10,000 into super, like my example earlier, get the $3,200, and then you're allowed to take out your $50,000. So you can pump your super up with a tax deduction to get the $50,000 out to buy your house deposit.
There you go. Just before we get to the Greens, Roy, I want to ask about instant asset write-off. Could you just give a little bit more of an explanation as to what that is? Because both parties are taking an instant asset write-off policy to the election.
So a business is operating and it goes out and buys a computer. Now, in the old rules, if that computer costs more than $1,000, you depreciate over time. But at the moment, you can buy any equipment, including cars, second-hand, you won't get much for new, but second-hand, or any equipment for your business, and the immediate tax deduction up to $30,000. But if you spend $30,001, the whole $30,001 is depreciated over time. You don't get the full deduction for the first 30. It's the whole lot gets depreciated. So it gives people an immediate sugar hit as a tax deduction when you buy the equipment.
And probably very helpful for cash flow for small businesses and tradies and sole traders, etc., or smaller businesses. I'm guessing
it's an incentive to go out and spend money, is what it really is, to kick your business along. I'm in favour of it, and I think the idea of a $30,000 permanent, or even if it was $20,000 permanent, I think this thing about having it every year, we've got to wait for another government to pass the legislation. I think making it permanent is a good thing with both political parties.
The Greens also promising plenty in the lead up to the election. What have they got for us, Roy?
Well, my mission is not to tell you who to vote for. You make up your own mind. Now, the Greens have brought in a negative gearing for one home only, one investment property, and all the others, no negative gearing. So if you've got more than one, you probably don't want the Greens to get voted in. The 50% capital gains tax discount is to be abandoned, so you no longer get the capital gains tax discount on property. Share market capital gains will be calculated using the inflation indexation rate. When they invented capital gains, that was an option many, many years ago. We got rid of that and replaced it with a 50% discount. All student debts we've written off. So if you're a student, you may want the Greens to get in because you'll have no student debt. Rent increases capped at the wage growth index, and Airbnb limited to 90 days per year.
Roy, we know that all eyes in Canberra are on RJ Sanderson TV in Season 6, 2025. What's your message to Canberra ahead of the federal election? And in particular, have you got any advice?
I do. I actually have a few ideas, and I think this is what the politicians should listen to. Currently, we know that the tax-free threshold is $18,200. That means if you earn up to that, you pay no tax. I argue increase that to $25,000. To me, it's a no-brainer. The benefits everybody, especially those on low income. You pay no tax if you earn up to $25,000. That gives a benefit to everybody of $1,224 per annum. Make it permanent, not temporary. And the other policy I would bring in, and the politicians are hopefully listening, excessive profits tax, which I believe should be an additional 10% tax if your profits are over $100 million. You could make that one temporary because we don't want to lose investment in Australia. So you tax at the normal rate for the first $100 million in profit. After that, there's an additional 10%. And I think that will help balance our budget and hits the mark. So politicians, if you're listening, I want to hear those policies going forward.
They're listening. Whether they take it on board or not, Roy, is another matter. But let's change pace and have a look at some of the economic indicators, starting with the stock market. And it's been volatile, to say the least, lately, Roy. A wild ride over the last week in particular.
Yeah, so this graph is 3 months. I wanted to give you some perspective on what just happened. We did peak at over 8,500. So we actually had an over 10% drop. And then in the last week, we recovered by 5.5%. So there's a message here, and the message is don't sell. You only lose money if you sell, because over a 20-year time frame, it's consistently recovering and going up. So that's 20 years. You see that little last tick on the far right-hand side. That's this week, this month, where it dropped, but it's already recovered half what it dropped. So if you're still sitting in the share market, I would be staying in the share market. I wouldn't be selling and crystallising those losses, because there will be a recovery.
It's interesting to note, like if we just have another look at that 20-year graph there, you can see some of the key moments in time, and you've indicated some of these drops there. You look at that drop in 2008, which is the global financial crisis, and the scale of that drop versus the scale of the drop that we've seen over the last few days. And it's hard to avoid the headlines in this space, isn't it, Roy? Because if you're consuming the news every day, you're riding the bumps, you're riding the tariff announcements, you're riding the headlines on a 24-hour cycle, it is very tempting to take action, to sell, to get out. But when you look at the scale of movement versus 2008, and again, like you do need to seek your own independent financial advice on this, maybe it's not as catastrophic as it looks there. So I think the message there is clear. Go and see a wealth manager, let someone else take care of your money, and don't panic.
Certainly don't panic, and that 20-year graph puts a lot of things in perspective. The financial crisis was a huge drop, and I think that's what scares people a little bit. They're worried that's going to happen again. Then we had the second biggest drop in the last 20 years was COVID. So even though it's been a horrible feeling with tariffs and the stock market being volatile, I think you still sit. It's only small compared to the overall situation. You just got to sit tight.
The next one that we're going to have a look at is inflation. This has been the topic over the last 2 years for us, Roy. We've been tracking this number very closely. Can we call it? Can we say that the inflation crisis is over?
Well, we're just under the 3% band, because the Reserve Bank are targeting 2 to 3%. We know that the rebates for power costs makes up 0.3%. They're in for another 12 months. And I think that it will stay below the 3%. But there's one big uncertainty, isn't there, Dave? Tariffs.
Yeah.
And what effect they'll have on inflation.
And Roy, when we get to this next figure, which I think is the really big concern, is GDP growth. Now, you can have a look at this graph of GDP growth over time and see just where we're at on this. We are at kind of historical lows here, really. Like, obviously, we've got the big recession that we had during COVID. Outside of that, we haven't seen a recession since the 1990s. The concern for a business at the moment is, how do I make a decision for the long term when there is so much uncertainty around tariffs and around what's going to happen? So the current state of play, tariffs have been put on hold for 90 days. We don't know necessarily what's going to happen after that. So I would say that any business that's looking to make a big decision at the moment, or a decision that is going to be meaningful enough to impact that growth number, is putting that decision on hold. So I'd expect that growth number to continue to go down, because how can you make seismic decisions at the moment with so much uncertainty?
There's certainly uncertainty, and there will continue to be volatility. I have no doubt about that. But the one thing in that graph that I think was gold was the last month, there's a little tick upwards, so not downwards. And I think that is really, really good. And hopefully it continues on a slight upward GDP growth, and that will be good for Australia. But there's uncertainty.
This next graph may contradict that, Roy, because I think what you saw in that little uptick was representative of consumer confidence November, December, January, February, March, where we started to see our famous Brendan Bolton term, green shoots in the economy. We started to see, okay, we've seen inflation move down, we've seen an interest rate cut, things are starting to feel a bit better, but then bang, tariffs come along and we see the worst result in consumer confidence in 6 months, a 6% month-on-month drop. Now, when we go behind this consumer confidence data, the metrics are that most people have indicated that they're uncertain about economic conditions for the next 12 months. So I'd be interested to see whether that number holds in May or whether that goes down. We'll dissect it all in RJ Sanderson TV next month. But my suspicion is that it will either flatline or drop from here. And I think that's concerning. I think that shows how destabilising all of these announcements are. I think, Roy, people can deal with announcements that are coherent and logical and make sense, but when they chop and change continually, that's when it becomes very difficult to make a decision. If you're thinking about buying a house or if you're thinking about making a big investment, you need some level of certainty to make those decisions. At the moment, and we see this with consumer confidence, a very agile number and a very reactive number to what's going on in the economy and in the media. And we're seeing that people are uncertain suddenly, and it's all off the back of the tariff announcements.
I think that huge drop was Trump-related or tariff-related, and I think the timing of that survey and those events around the world is what's dented that. Huge drop, but if you actually look at the average over the last 12 months, we're right on the average right now. So even though it was very bad and then it got very good, it's now about where I would call it average. I would hope that if we have less volatility around the world, and I'm talking about tariffs and announcements from the US, then that will improve. But if we don't, and it continues to be wild announcements and attacking Canada or Greenland and statements that seem to be completely left of centre, then that consumer confidence number won't increase.
Let's have a look at some housing numbers now, Roy. In kicking off with the change in values of dwellings over the last 12 months, what's the takeaway from this one, Roy?
So the last 12 months, the average is 3.4% across Australia. Bear in mind, the last time we did this show in 2024, that was around 5.5%. We look at what the worst performing state is Melbourne at 2.6% negative, so it's gone backwards. So Melbourne is dragging back some of the averages. Some states have done very well, Perth, Adelaide, Brisbane, where the others haven't. So I think that's indicative of what is happening in Victoria with policies and taxes, that the dwelling prices are decreasing.
In terms of rentals, what have you taken from this number, Roy?
Well, this is probably a good thing for everybody who rents. Interestingly, their investors are selling out of the market, which indicates if there's less investment properties, there's pressure on rents to go up. But rents are increasing, not at obscene levels like they were at around 9% for quite some time. They're now increasing at 3.8%. And the ideal number is probably around the inflation rate. So if inflation is at around just under 3%, I'd like to see that to continue to decrease. So it's just under the 3% mark. That would be, to me, a logical rent increase number.
This investor finance number that follows this one is a good indication of what you talked about before, whether investors are staying in the market or leaving the market. What's your breakdown of this one?
So just to explain this graph, this is investors as a portion of total lending, and it excludes refinancing. So the investor percentage in Victoria, is 30.3%, way behind New South Wales, who's at 43.7%. And this just supports my comment a moment ago that says Victoria has some problems with compliance and taxes that's causing investors to look at this and going, I just don't want to be in the market. And I can't see that changing. I don't think there's anything, unless governments in Victoria make some massive changes, I suspect Melbourne's property market will continue to decline. So does that mean I should sell, or does that mean there's an opportunity to buy? I personally would suggest, firstly, see a financial wealth manager before you do this, but I would say there's going to be some bargains, especially in holiday type destinations like the Mornington Peninsula, like some country regional areas, Phillip Island. I think there's going to be some discounted prices where the astute investor will say, I'm going to jump in now because these prices can't continue going backwards or be at these low levels for much longer.
It's an interesting point you make, Roy, and a point that I want to make on this is one thing that I really think is lacking from the discourse on housing is some targets on what we are actually trying to achieve. I feel like there is an absence of guidelines. You mentioned the inflation rate before. It's very clear in terms of macroeconomic policy that Australia is targeting an inflation range between 2 to 3%. We know what our targets are for growth. What actually is our target for housing? Is it home ownership? Is it price decreases? Is it investment? Is it rent? What actually is the set of guidelines that a government is trying to achieve? Because we hear that we're in a housing crisis. We hear that there is housing issues, and there clearly are. Eventually, I feel like you have to actually set a list of priorities, and some people are going to miss out, and some people are going to win out of that. And that's what an election is trying to decide: is who needs support, who doesn't need support, how do we balance out the community in this way? I just feel like a set of principles or guidelines around what constitutes success in this space is actually missing from the debate, because we can continue to tinker with taxes here, or we can continue to reform on this, or we can build more houses, we can build more apartments. To what end? When does it stop? When are we officially out of the housing crisis? When are we into a period of acceptable housing? I don't think anyone knows the answer to that, and I would urge the political party, we know you're watching in Canberra, by the way, I would urge the political parties to come out and say, this is what success looks like in housing. We want this number of people in new houses, plus, you know, we need house prices to remain steady and investment at this level, or whatever it is. Come out, put your policy on the line and give us a clearer picture on what would constitute the country having come out of a housing crisis, so that industry and consumers alike, and governments, and that includes state and local governments, can actually define what success looks in that space. Right.
So, Dave, on that point, I think the policy at the moment with the government is to focus on first home buyers. There's so many incentives in that area, but their attempt to incentivise for more housing is not necessarily the houses that Australians want to live in. Multi-storey condos, apartments, small 1 or 2 bedroom places, that might suit some people who are immigrating from overseas because that's their lifestyle that they aspire to. Australians tend to want a townhouse or something out in the suburbs. It is not necessarily a high rise in the city. So I think we're spending too much focus on trying to build these high rises, and I just don't think that's the Australian way of life.
It's a good question. Again, like I don't disagree with that point, and I don't necessarily agree with it either. I don't know what the answer is, because, as you say, you know, maybe it's not working. I certainly don't think the solution is to go and build houses 3 hours from the city either, or 3 hours from working places. And we've mentioned this on previous shows. What is the Australian dream now? Is it to go and live a long, long way away and spend most of your life in the car? I don't think so. I agree with you that I'm not sure the Australian dream for most people is to live in a high rise, but we need to be able to set an ambitious target and work towards that collaboratively with the support of all key stakeholders and the alignment of all key stakeholders. And I don't currently think that that's happening. It's a huge challenge, and one for governments beyond the election, and for many tiers of government as well. It requires cohesion between local, state and federal governments, and no doubt, you know, people will continue to put time and effort into devising these ideas, but I still think there is a key piece missing, which is a strategic framework that defines success in this space. So we'll wait and see.
We'll see what Canberra come back to us with.
Speaking of feedback, we've had a bit of feedback from our audience, Roy, and we'll kick things off with a question that has come through. A very interesting and simple question: can I claim parking where I work?
Yes. If you have any other questions, send them through by email to roy@rjsanderson.com.au and we'll answer them if we can. So, can I claim parking where I work? It's a 2-point answer. If it's where you normally work, the answer is no. So if you're on a building site for the next 6 months, the answer is no. Where I normally work, my office, I have to pay for parking. The answer is no. But if I have to travel out to a different place of work, a temporary place, visit a customer, drive to the city because of a work meeting, that parking is tax deductible. Now, this is a law I would change because nurses have to pay for parking, and I think that parking cost should be tax deductible to nurses.
Okay, interesting one there. Second question that has come through from a viewer: how much do I need to start a self-managed super fund?
Now, I have heard wealth managers say you need 700,000. That's not correct. You need somewhere close to 200,000, and that's in accordance with ASIC guidelines. Now, the reason you need around 200,000 is because the fees for a self-managed super fund are fixed, whether you got 200,000 or 2 million. And if you've got under 200,000, the fees as a percentage of your investment are probably too high. But you would never start a self-managed super fund without talking to a taxation specialist first, so that they can explain the regulations, see how it applies to you, see what your goals are, and seeing if a self-managed super fund is part of achieving those goals.
And the final question that has come through from our viewers: I work on a computer all day. Can my reading glasses be claimed as a tax deduction? And I really want to know the answer to this one, Roy.
You want to take a stab at it, Dave?
I'm going to guess no, unfortunately.
Yeah, so the ATO or the government treat glasses, reading glasses, even though you need them at work, they're treated as a medical costs. Medical costs are not tax deductible. So reading glasses, the answer is no. Protective glasses out on a building site, the answer is yes. Sun protection, like sunglasses, because you're out working outside, the answer is yes.
Okay, so there's some you've got to be specific in which glasses you're talking about, but reading glasses, no. Right, Roy's Rage is our next segment, back for a 6th year. Roy, what have you got for us today?
Well, we know for a fact that negative gearing was actually invented in 1936. It was invented to fix a housing crisis at the time. Now, right now, we have policies that I'm talking from the Greens and from the Victorian State Government, which seem to discourage property investment. And guess what? We're in the middle of a housing crisis. So we're doing the opposite to what we did in 1936 when we created this thing called negative gearing, giving people tax deductions to try and get more housing out there so we got more rental properties that people need to rent. So I think the government, if you're going to be in government and you're going to make decisions for us, you need to do an economics course of some sort. It should be compulsory because state government, Greens, you've just got this so wrong on the basic fundamentals of economic policy, in my opinion.
Bang. Roy coming off the long run there. And yeah, if you are a politician, make sure you get down to your local university to start your economics course, because Roy's coming after you. Right, we're just about out of time, Roy. Before I let you go, though, a couple of predictions for next episode, which will be in May. First question is, what do you think about the stock market? Buy, sell, hold at the moment?
Positively hold. If you're still in the stock market, it's too late to sell. You shouldn't sell because that crystallises loss, so hold. That's a hold.
Interest rates, do you expect a rate cut?
I don't believe we should have a rate cut while an election is in play, because it could influence voters. So the Reserve Bank needs to be apolitical, and I would delay the rate cut until straight after the election. And will we have a rate cut after the election? In my opinion, absolutely yes.
Oh, it's been a good one, Roy. Thank you so much for joining us on RJ Sanderson TV. If you've got any questions, please do send them in. We hope you've enjoyed the show. RJ Sanderson TV, the first episode for 2025.